Hello, guys, and welcome to Invested, where we talk about stocks. So today we're going to talk about ICICI Sec and angel broking. Brokers in general have had a very good year, especially these two guys. In this video, we'll talk about the industry trends, how these brokers are transforming the business, and is this trend of high growth really sustainable? So let's begin. Last year there was a 35% year-on-year growth in demat accounts, right? And this is not just last year. The growth for the couple of years has been pretty strong. Now, a lot of people think that this is because of guys working from home and having a lot of time at hand. And that is true to some extent, but there are other factors at play. A lot of this growth has come from tier 2 and tier 3 cities. Even after such a jump in demat accounts, penetration in India is just 4%. Now compare that to the US. India isn't going to be US anytime soon, but we can definitely get to China's 11% pretty soon. The second point is that there's been a lot of consolidation in this industry. As you can see from this chart, the top five guys now account for 52% of active NSE clients. Active means any client who has traded in the last 1 year. There are reasons for this consolidation. Compliance cost is going up. SEBI keeps coming down with new norms, new regulations. There have been a lot of broker-related frauds. The most famous one lately being the Kavi episode. So last year, top five brokers got 67% of the incremental clients, right? And ICICI and Angel Broking are part of this top five club, and that's why we're interested in them. Now just look at the client addition that's happened over the last quarters, right? In last 24 months, Angel has gone from adding 68,000 to 956,000 clients a quarter. And ISec has gone from 98,000 to 954,000 clients a quarter. And if you listen to these guys, the management teams, they're very confident of sustaining this rate. In fact, Angel's MD believes that this can go on for the next 5 to 7 years. And the other factors at play, right? Online KYC has been a game changer, especially for people from tier 2 and tier 3 cities. Now, because these places with population of less than 1 lakh, there wasn't much incentive for a big broker to set up a branch office there. Today, you don't need to do all that. It's all digital, right? Then, of course, there's increased mobile penetration, which helps you trade easily. And lastly, interest rates have been trading lower. FDs and bonds are not giving you returns what they used to, right? So where do you park your money? Now, these brokers have seen the business model undergo a transformation. Your broker is now trying to be a platform. So thanks to these discount brokers over the years, brokerage charges have been trending down, right? And because of which, it's forced most of the industry to move from a yield-based to a flat fee-based revenue model. Example, earlier if you traded, say, stocks worth 1 lakh rupees, your broker would get 1%. But today, whether you trade one share or 1,000, you get charged the same, right? So the charge is per trade and not on volume per se. So broking charges today are so low that pricing is no longer a differentiating factor. It's all about what the broker can offer you. And for brokers, the focus has shifted from broking to cross-selling financial products. Think distribution of mutual funds, health insurance, life insurance, loan against shares, property, wealth management. Secondly, now that you are charged per trade, as I said earlier, number of trades means more broking revenue. So these guys are incentivized to make you trade more, right? A long-term investor is bad for business. And lastly, physical to digital. Now, this is the most important point on the slide. Brokers are now competing for your attention on your mobile. So customer experience on the app is what matters today. For a first-time customer, the digital journey from opening the account, doing online KYC, getting investing ideas, placing his first trade, all of this has to be seamless and engaging. Tomorrow, if for some reason the client becomes inactive, you should be able to nudge him to trade again. So both ICICI Sec and Angel understand that once a customer gets used to your app, all his needs are met, he's unlikely to switch. Just think about Swiggy and Zomato, yeah? In the early days, people used both, right? Today, most of us either use Swiggy or Zomato, and it's not because of the choice of restaurants. So to sum it, tech plays a big role here, and both these guys are very tech savvy. In fact, Angel's new CEO is a guy with a very strong tech background, right? He's worked with Google, Ola, Amazon. Now, Angel versus ICICI, which one is better? The answer is neither and both. Because the value proposition to a customer is different, the strategy is different. Someone might want advisory, someone might care only about pricing, someone cares about wealth protection, someone cares about wealth creation. Different customers have different needs, right? A Domino's can't serve a customer who wants McDonald's and vice versa. So Angel is positioning itself as a pure retail brand, right? Its strategy involves getting market share, getting new clients, especially from the tier two and tier three cities, because it feels this is a hardly a huge underpenetrated market. And it's going completely digital. It used to be a full service broker with lots of offices like ICICI broker, but now it's fully digital. ICICI has also shut a lot of its offices, but it will remain a mix of digital plus physical. And the advantage with ICICI is that it can tap into its parent ICICI Bank's network to get clients, which it does very effectively. And ICICI is more focused on gaining market share, but with quality clients who can increase its average revenue per user, right? They're concerned about the ARPU. Angel, on the other hand, is currently focused on gaining market share. So, as I said, the strategy is very different. So, you'll have to judge them by different metrics. ICICI is obviously a more diversified player, right? It has something for everyone. Traders are conscious of pricing, so they have a plan for them. Investors want research and investment advice. They have their own PMS, they have investment banking, right? They do IPOs, they have 20 different kinds of loans. So they have everything that a client can need. So this chart further illustrates my point of ISec being a truly diversified player. As you can see on this chart, ISec gets 57% of its revenues from retail equities. Now, retail equities also includes margin funding, right? What is margin funding? So let's say, for example, you have 40 rupees and you want to buy share for 100 rupees. So you need 60 rupees more. So your broker now gives you 60 rupees. This becomes your margin, right? The 60 rupees that your broker gives you is your margin, and the broker earns interest on this 60 rupees that it just gave you. So ICICI also makes money from distribution of mutual funds, loans, does wealth management, institutional equities, all the things that we talked about earlier. And as you can see, it's very well diversified. Angel, however, gets 70% from broking and 15% from interest income. Now, this interest income includes margin funding. So, all in all, you can say Angel gets about, say, 85% purely through the retail equities. Compare that to 57% of ICICI. But as I said earlier, Angel's strategy is to get market share, and after getting market share, they aim to cross sell it. Now, Angel wants to be the largest retail broker, and Angel's primary focus is to gain market share and make that relationship sticky so that in the future they can do what ICICI is currently doing in the retail segment. Now they're both investing heavily in tech and they're building teams. In Angel's case, high growth of broking revenues is what you're going to see. But in ICICI's case, it's going to be a mix of growth from broking as well as increasing revenue per customer. Because that's what matters to ICICI more. So last year, the ARPU for the retail segment grew by about 16%. And eventually, that's what matters. It's not difficult to get market share for any of the top guys. They all have good products. You just have to spend intelligently on digital marketing. What matters is the quality of customer, how much revenue a client can generate over the years. ICICI, in my opinion, has already proved itself on that front. Angel needs to prove itself, but they're going in the right direction. They're falling into asset management business. Most of these are not going to be your traditional mutual funds. They keep talking a lot about AI and machine learning. So I think it's going to be something on those lines, like smart beta products or something. We'll see. We'll see how it turns out. ICICI is also focused on introducing a lot of new products, and they have been containing the fixed costs. Right, a lot of people now are working from home, which was not the case earlier. So this will definitely help reduce the cost also. Now let's have a look at the financials. So if you look at the cost to income ratio, it has gone down considerably for these guys. There's a lot of operating leverage at play here, and a good client can bring in revenues for a very, very long time without any cost. Now both these guys have had a very good FY21. We are not so sure if this can continue. We honestly think that this will moderate. I mean, they'll still go much better than the market, but we expect this to moderate as more and more people start going back to work. Let's talk about the risks involved. Broking revenues are largely cyclical, right? They're tied to the market condition, and whenever there's a major correction in the markets, these stocks will correct. Now, in spite of all this diversification, bulk of the revenues are related to the health of the stock market. And secondly, there are too many things happening in the fintech space, right? That it's really hard to sustain a competitive advantage for too long. And when your differentiation is largely based on technology, uh, it's very easy for the competition to eventually close that gap, right? Technological modes don't sustain for too long in the space. So anyone invested in the space has to track the space very closely for any tech disruption. Then there's the regulatory risk, right? SEBI keeps coming with new norms, new margin requirements, new regulations, this, that. Uh, it's all for the protection of the retail investor, but a lot of times over-regulation can do more harm than good. And lastly, there's mimetic behavior. What we have noticed over the years is that in a bull market, a lot of newbie investors make quick money, tell their friends about it, share the success story. Before you know this, these friends have demat accounts, and sooner or later, everyone that you know has a demat account. Plus, new traders are eager to book profits and look for new winners. So this happens a lot in bull markets, and it leads to a lot of trading activity. So when the music stops is anybody's guess. So these are some of the risks that one has to consider before investing in this space. So now let's look at the big picture. So in spite of supernormal performance, both Angel and ISec are trading at P multiples of only 22 and 18. And that's largely because any industry which is cyclical does not get good valuations. And that's what broking typically is. So the game is about reducing the cyclicality of your business by leveraging your platform to cross-sell financial products. Today, your platform is your distribution reach. So in the near future, you'll see a lot of third-party apps and companies, wanting to partner with these guys for the distribution reach. So if these guys can prove that they can successfully cross-sell third-party products when the broking revenues dip, then they can reduce the cyclicality of the business, right? And they can enjoy a much better valuation. So to sum it up, huge underpenetration, top guys gaining market share, adding new revenue streams. So the big picture does look good, but anyone invested needs to have a very long-term view because there will be a lot of volatility in earnings and a lot more volatility in the stock price. So guys, that's it from our side. Hope you enjoyed the video. Please help us grow our channel by liking and sharing this video. Thank you. We'll see you next week.